having me. Thank you for having Emerging Markets on tonight. And I actually think this is a really opportune time to be speaking to you. So I'm pretty confident you've not been hearing too much about emerging markets. It's been a really difficult few years for the asset class. But I think part of the headwind and maybe why we've been in the shadows, the story of US exceptionalism, that's starting to roll off, which I'll come to later in the slides, really reminds people about what emerging markets can bring by way of diversification to a portfolio. And if I could move forward one slide, please, this is exactly where I want to start, right? What can emerging markets bring to your portfolio? Well, you can see here I've got three numbers up on the screen. What are they? 86, this is the percentage of the world's population that lives, works and consumes across the emerging markets. 41% is the contribution that emerging markets give by way of GDP, global GDP. So they're contributing 40% of global GDP. Yet the 10.3 is the percent that emerging markets are in weight in MSCI All Countries World Index. So a real imbalance there, that you've got 6 billion people living, working and breathing across the emerging world, and you probably have very limited exposure to that in your portfolio. So I just want you to have those numbers in mind as I go through some of the ideas, some of the opportunities that we're seeing across this huge, huge swathe of the world. So if I could move forward one slide, please. I thought I'd actually kick off by talking to you about some of the businesses that we hold today in the JPMorgan Emerging Markets Investment Trust. Why do I want to talk about companies straight away? Well, because that's what we are. We are stock investors. As much as emerging markets, this big mix of all these different countries, offer a lot, we actually see far greater benefit to our investment insight by really drilling down, by looking over 1,200 companies across emerging markets and finding where we perceive the best ideas. So the other point is that they're coming across the region. So if I start off with this first name that you see here, a company called Capitec Bank. So this is based in South Africa. It's actually known as South Africa's simplest bank. It focuses on low fees and transparency of products, and it's really disrupting what I would term the traditional giant banks and banking giants. It has been rated for years top of the satisfaction charts for South African banks. So a really good place to start. Where I think it's shown its edge is that it currently has 20 million customers, and that's in a country of only 60 million. So 1 in 3 South Africans bank with Capitec. So we find that a great opportunity in South Africa. Now, if I think about Asia, I've actually got 2 Asian businesses here, both of whom are based in China, but you will realize that they do something very different. So if I start on the right-hand side, you can see a company called Hongfa Tech. So what this is the world's largest relay manufacturer. Now, if like me, you don't really know what a relay is, it's basically a switch used to control a circuit. So it allows one circuit to control another without the need for direct electrical connections. So what does a relay mean? It's basically a hidden but a very critical role in electronics, in EV, in industrial automation. So if you think of it very simply, if you've used a car or a lift or even a household appliance, there's a very good chance that the relay inside it is made by Hongfa. They export products currently to 120 different countries. Now, the other Chinese company I was going to raise was Trip.com. I think the clue is in the name. It's actually Asia's largest online travel agency. What's interesting is it actually owns Skyscanner. I imagine many of you have used Skyscanner when you're looking for flights for your holiday, so it's actually owned by this Chinese company. Trip.com, the Chinese portion of it, handles 50 million customer interactions annually, many of which they use AI chatbots. And so again, this is a great play on mobility and travel picking up in China, but it also has that broader connection through Skyscanner. And then what my favorite story is, and this is going over to Latin America, Arcos Dorados. This is the world's largest McDonald's franchisee, operating every single McDonald's in Latin America and the Caribbean. Now, the clue is in the name. Arcos Dorados means golden arches in Spanish. They operate nearly 2,500 restaurants across 20 markets, and it's actually the largest employer of young people in Latin America. So really different opportunities spread across all three regions that we look at within emerging markets, and just giving you a flavour of where we see some of these long-term potential investment stories. Now, let me change tack slightly and let's think about the elephant in the room, right? You're listening to me talking about emerging markets and great stories, but you're like, hey, there's a lot going on in the world. So if I could move forward one slide, please. What are the risks? I imagine if I'd asked you to write down what you perceive today to be the risks to emerging markets, you would cover pretty much all of these names. Right? You've got tariffs, you've got geopolitics, you've got what the Fed Reserve do next, you've got the pressure in different markets. Look, what's basically happened, and we all know this, is America, the US have picked a fight with everyone else in the playground. And emerging markets, you could argue, have been front and center of a lot of that, especially with the likes of China and Mexico. Now, to us, the tariff noise is starting to calm down. I'm sure you'll hear that from the other speakers later. We are now, 4 weeks past from Liberation Day. I think markets have calmed a little bit and processed it. You've seen some negotiation, but I think also, interestingly, you've seen a recognition that the US are as if not more pained from a lot of this as other markets. Now, what does that do for us as investors? We are not trying to second guess what gets unwound or what gets changed. But instead, we need to start really thinking about, and have been thinking about, where are the areas that maybe the market has irrationally sold down? And if I could move forward one slide, I think this is a great chart from the JPMorgan Guide to the Markets packs. It's a very strong franchise that we have. If you haven't ever used it, just go online and type it into your search engine. And it just brings up an awful lot of long-standing charts that allow you just a context around what's going on for different global events. So the chart that you see on the left, the only bit I need you to focus on is the sky blue. Because what this is showing you is the revenue exposure domestically of different markets. Okay, so what you're basically seeing is that Indonesia is an incredibly domestically orientated market. You can see China is also very heavily domestic, even though there's all of the headlines. And as I move further to the right, you can see Korea and Taiwan there, where the domestic exposure is far lower. And that's because if I think about those two markets, they're far more tied in with global growth, and especially with technology. So Korea leads the world in memory, that clearly goes into pretty much everything nowadays. And similarly, Taiwan with semiconductors. Why am I showing you this? Not all emerging markets are impacted equally. So for us as stock investors, we can look at different markets and continue to find fantastic ideas that the market in the last few weeks has irrationally sold down. So let me just give you a flavour of Indonesia. The image on the top right is essentially a bank. So BCA is Indonesia's biggest private bank by market cap. It's actually one of the largest companies listed in Indonesia. Why do we like it? Not only did it lead the way in many areas, but it definitely led the way in mobile banking, rolling out mobile banking across its Indonesian customer base since around 2006. And today, 99% of its transactions are conducted digitally, so either mobile or internet. So Indonesia has been hurt. You've seen the impact on currency as well. But with a domestically orientated name such as BCA, we find that a really attractive place to be investing in that market. Now, I recognise I'm presenting close to dinner time, so hopefully the picture at the bottom doesn't cause your stomach to rumble. So what's this? This is a company called Yum China. So Yum China operate Pizza Hut, KFC, Taco Bell across China. KFC in China is so popular that there are more KFC stores in that market than across the United States. What they've also done is really adopt AI. They were one of the first restaurant chains to roll out AI-powered kitchens and robotic servers. So again, very domestically orientated, right? This is about having 9,000 stores across China selling fast food to the Chinese. So I just want you to look at that slide and remember in your mind that not all emerging markets are created equally. If I could move forward one slide, please. I just want to go through one of the other impacts of the tariffs, and that's been on the US dollar. So those of you who I've spoken to before will know that we always talk about the US dollar as being very conducive to emerging markets when it weakens, but when there's a strong US dollar, which is what we've seen in recent years, it creates a real headwind. And the tariff and the implications on the US has seen the dollar weaken. You can see it's gone from 1.25 times as a real effective exchange rate, i.e. it's 25% more expensive than we expect its long-term value. It's come down to 1.11, and actually today it's 1.08. So it's still expensive, it's 8% expensive, but that's a long way off from being 25% expensive. And a weaker dollar combined with resilient growth from emerging markets can provide a really good backdrop from the asset class. So I think the dollar is another support that, to me, makes you feel slightly, or rather incrementally more positive to the asset class. Okay, so let's now just think very briefly about the two main markets of EM. So if I go forward one slide, please. China, been in the news a lot. I'm not going to go through what's happened in the last couple of years, but what I do just want to touch on, which the chart on the left-hand side shows, is one of the outcomes of a very weak economy and market backdrop for China in the last couple of years has been improved corporate discipline. What I mean by that is you've seen dividends, so the blue portion, and buybacks go up. You're basically seeing management give more money back to shareholders to reward them for investing. And that's got to be a good thing. Now, what that does, as the slide on the right show, is as you get to a stage where you're getting buybacks and you're not having share dilution, it can be additive. Just as you see when you look at the yellow line in the bottom right, that in the US, net buybacks are additive to earnings per share by about 2% a year. So what we're seeing overall is Chinese corporates and their management being far more sensible and thoughtful with their money and giving back to shareholders. And that's great for us from a corporate governance standpoint. India, if I move forward one slide, please, continues to have the long-term story in place that it's had for many years. And that's one of a population that's not just getting richer, which are the pyramids that you see on the right-hand side, but also that they're leveraging their lives more. What I mean by that is when people have more money and they have the ability to pay back a loan or a mortgage, they clearly take that out. And why that's good for us is it brings together both the consumer sector, i.e. companies where when people have more money in their back pocket, they're choosing to spend money on their goods and their services, but also financials, the banks that fund that leverage, the likes of HDFC and Kotak Mahindra Bank. And so what we've seen in India is this trend continue. You've had a market that's moved quite a bit in the last couple of years, but this type of theme I'm showing you, that's multi-decade. It's not just multi-year. There's huge growth potential. In fact, in the next decades, there's an expectation based on current forecasts that per capita GDP goes up 2.5 times in India. So it's got a really strong growth trajectory that our consumer and our financial names can participate in. So hopefully that gives you a good backdrop to where we see opportunities and some of the trends that have been changing. If I just move forward and spend the last couple of minutes thinking about JMG. So this is the Emerging Markets Investment Trust. What's our hallmark? Our hallmark is about the experience and the strength of expertise that we have across our business. We have nearly 100 investment professionals whose ideas feed into Austin Foray and John Citron, long-term decision makers on the product, really focusing on finding those best businesses. And I think that's the key point. The focus that we have is on companies rather than markets. We're not taking a market view. And I think the tariffs really highlight why you shouldn't be doing that. You want to be able to differentiate between a domestically orientated business and an export business that's likely to be caught up more in a lot of the market noise that we see going on right now. What we ideally want to invest in is a return to corporate skill. We want to use the strength and experience of Austin and John to find managements that we believe we are aligned with. and to buy and hold those businesses over the long term. And that's something that we've been doing in running this product for over 30 years. The beauty of the investment trust vehicle means that you can buy and hold and compound. We've got some names in this product that we've actually held for over 20 years. So a really good sign that if you've got the right people and you've got the patience, you can find some really strong compounding businesses that we can be exposed to. So what are those businesses? If I move forward one slide, please. Let's just have a look at some of the key names involved in the portfolio. I won't go through all of these. I think there's a couple of things I just want to tease out. I recognise there's a lot going on this slide. Firstly, is the fact that we want to be investing based off our conviction, not what the index is telling us. An index by nature is backward looking. We want to be looking forward into the champions of the future. And so when you look at those right-hand side tables, you can see the relative weight. Think of that as our conviction, right? We want to be overweight the businesses that we have conviction in. Mercado Libre, this is basically the Amazon or the Alibaba across Latin America. TSMC, Taiwan Semiconductor, the dominant semiconductor manufacturer globally. In contrast, we're very happy to have no exposure to bigger names in the index if they don't fit what we're after. I'll draw your attention to two Chinese names down there, Xiaomi, which you may well have heard of, they've just gone into EVs, and Meituan, which is a food delivery company. Think of that as the Chinese equivalent of Deliveroo or Uber Eats. What links both of those is we feel they have weak economics. They're so desperate to gain market share, their focus on their economics isn't there for minority investors. Their margins are being eroded. They're engaging in essentially price wars. That's not a good outcome for you as our shareholders. So these are companies that you may well see in the headlines, but over the longer term, which is our holding period, we don't see them delivering. Now, the final point I just wanted to make on this slide is if you look at the left-hand table, the penultimate name, a company called Clix. Why do I want to highlight this? This is a great example of a small cap name where we can take liquidity risk because of the closed-end structure of the investment trust. So Clix is a South African pharmacy chain. Think of it very similar to Boots or Superdrug. It's just under $5 billion US. And this has been a long-standing holding that we're able to participate in because, as I said, the investment trust vehicle means that we can really push down into the small caps and really find those mispriced names and those undiscovered companies that we see continuing to do well. Now, if I move forward one slide, I've given you, I think, hopefully a very exciting story around why emerging markets is great. And you're going to look at these numbers and say, but Emily, there's a lot of negatives on that page. And as I said, it's been a really difficult few years for the asset class. There's been a lot of pressure on China. There's been pressure on other markets, especially from a currency standpoint, added to which the US has been the only game in town. And you can see that when you look at that 3-year number. But what I would ask you to do is just look further to the right. Because even despite what's happened over 3 years, the 5-year and the 10-year numbers are still 6–7% annualized in sterling terms. That's a really good diversification and input into a broader portfolio. And as I said, when I look at emerging markets today, I feel a lot of those headwinds are turning into tailwinds. There is still going to be volatility, right? We know that. We know that we're only 100 days into Trump. We've seen the impact that's happened already. But our view would very much be one that a good company doesn't turn bad overnight, regardless of if its share price moves down. So there are times that I think EM has been challenged. I think a lot of the weight on our shoulders is lifting. And so right now, I would encourage you to just keep looking at the asset class. So in summary, if I move to my final slide, please, what do I really want you to think about? Well, look, there's 3 areas. It's a huge asset class. 80% of the world's population live, work, and consume. That's not changing. There are some absolutely fantastic businesses that we can find, but you can only find that when you have people out on the ground speaking the language, when you have the resource behind you to really go and dig and find those hidden treasures. And that team, I think, puts us in a really strong position to create those ideas that our experienced PMs, Austin and John, can really weed through and find the companies that they believe are exactly the right ones to be holding to give us that really broad exposure. And I think the final point is that what the investment trust vehicle allows us to do is not have to worry about cash flows, not need to look at the likes of liquidity as much. It's really focusing on drilling down and finding the best businesses that we can buy and hold and compound. So with that, let me pause, and I'd be delighted to take any questions that people have.
First up, question about stock selection process. The question is saying, you mentioned there's 1,200 companies in your view. How do you go about choosing which ones to invest in?
Yeah, no, and that's exactly the right question. It's a great question, and it's all done through our insight. So I guess the first thing that you can do is you can screen different companies based on the underlying liquidity, because we still need to be able to trade in and out of them. We want to be looking at the corporate governance and the ESG, for which we have an internal proprietary metric where we're looking at different risks. Companies with an above average number of risks are just not going to fit for this portfolio because we want to be so long term. And then we also want to look at different financial metrics. So I think one of the hallmarks of what Austin and John put together are companies with balance sheet strength. So you want companies that aren't using a load of leverage, right? That they're in control of their profits and how they pay them out to investors. And I think the other metric that we want are companies that are profitable. So something like return on equity is really important. So we have a number of different factors that we look through. But I think the biggest one is one that you can't screen for. It's the subjective one. It's the going in, meeting with management and essentially sitting across the table saying, do I trust that they are going to do the right thing for my shareholders? And if at any point you have a doubt in your mind, it's the wrong business. So I think as much as the numbers side is really important, for us, it's about the trust and the company doing the right thing over the long term. And from that, you can just filter down. The one thing I would also just add is valuation is important, right? You don't want to be overpaying. So you could have some really good companies come up from all of those metrics. Now just might not be the right time. You can think of them as almost going onto a watch list, that it's got the right caliber and characteristics, but we just need the price to be a bit more reflective of reality, essentially.
And further to that question about family businesses, do you invest in companies which have strong family connections or family control?
Yeah, do you know what? That's a great question, given it's emerging markets, because it's something that I think you find is much more prevalent across our asset class, that family ownership, companies passing down through generations isn't abnormal. I think it's becoming slightly less common, but it's not abnormal. And I think the reason it's such a good question is it does raise a red flag to us. And it raises a red flag. It doesn't mean we'll never buy it, but we need to be really sure that it's the right people, because just because you've been passed down a business or you've been asked to sort of join the family business, you might not have the right skill set. And to us, that skill set, that corporate skill, is so important. So all things being equal, if you had two companies that looked and felt the same, we would typically go for the company that didn't have family ownership. It's not to say we never would, but we've just got to be very cautious of, are they doing this for the right reasons? Do they actually know what they're doing once they're behind the steering wheel?
A question here on tariffs. Did you use price changes as a result of tariff announcements to make any new investments?
We actually did. We lent into a couple of names that we already held, where we felt that the price had essentially come down irrationally. Something I mentioned earlier on in the conversation was that distinction between companies that are very domestically focused versus those that weren't. But what you saw, especially in the first week after Liberation Day, was this indiscriminate selling down, that the market wasn't differentiating between where are the revenue streams coming from. So I think right now and over the past few weeks, our job has been to stay calm, to focus on fundamentals, and where pricing opportunities have opened up, we definitely have been leaning into them gradually, especially where we just think that it's sold off far too much.
Okay. Next question, you showed a chart showing the value of the dollar. Is there a correlation between that dollar price and EM markets?
There has been historically a decent correlation that, as I said, think about it, that when the dollar is really strong, so goes upwards on that chart, reaching, as we saw in the last couple of years, a peak of 1.25 times, that tends to be a headwind to emerging markets. Okay, so it's harder for emerging markets to perform well. In contrast, when the dollar is weakening and coming down, and especially when it goes below that line, i.e. below its fair value, it's sort of like 95, 98% of its fair value, you've historically seen that that's conducive to emerging markets. It's a nice tailwind. Now, every situation is slightly different, which is why I say it's quite a tight correlation. But yeah, in theory, that dollar rolling off is a good thing for our asset class.
Okay. Final question. I was going to read this carefully so I get the terms correct here. Are you concerned about the potential huge risks of hedge funds with large bets on the US bond market backfiring and substantially raising risks across the world by sudden falls in asset pricing, leading to fire sales that could impact all markets? I guess it's kind of like systemic risk, isn't it? Did you see
Yeah.
this increasing or decreasing? Any comment on that?
Well, I think these risks are always there. They tend to be tail risks. As I said, I think I'd go back to the point I made in my comments that you've seen the market process, I think, in the last few weeks, a lot of what's been going on around the noise of tariffs, and the markets especially now feel a lot calmer. So I would say that it's not to say that risk that is mentioned in the question has gone off the table, but I think markets have normalized their view in a lot of these areas. I think these things are always risky. I think more broadly, I would argue that emerging markets have stronger financial and economic foundations than historically, right? You don't see those boom bust periods that you used to if I go back sort of 15, 20, 25 years across the asset class. So yes, it's a systemic risk. If something like that happens, trust me, it's not just our asset class that gets impacted. It's sort of, as you point out, Roland, bad news for pretty much every market. But it does feel, especially this week, things are a lot calmer in markets and people are trying to sort of look through and think through a lot of what's going on without the rush and the panic that you maybe saw after the first couple of days.
That's terrific. Emily, thank you very much. Thank you for joining us this evening.
Thank you. Have a good evening, everyone.